High yield feels good, especially when it's double digits. Cash hits your account, the statement looks busy, productive, like something is finally working. But here's the uncomfortable question most people never ask. What if some of that income isn't income at all? What if a double-digit payout today is being funded by reducing the value of the fund itself? Most investors don't stop to check, they just see the deposit and move on. So, in this video, I'm breaking that problem down step by step. You will see what NAV erosion actually means in easy-to-understand language, why avoiding it matters even to experienced investors, and how covered call strategies are used to generate income and where they fail. Then I'll show you the exact process used to separate durable income structures from ones that only look good on the surface. I'll show 5 ETFs built for income with no erosion, and in the end, I'll show you an ETF that can potentially turn 10 grand into $15,750 in 1 year and pay over $2,800 in annual dividend income from the very first year. To see how that happens, you first need to understand what NAV erosion really means. When people hear the term NAV erosion, it sounds complicated, but the idea itself is very simple. It's about where your income is actually coming from. Imagine 2 income ETFs that both advertise a 10% yield. On your brokerage statement, they look identical. Every month, money shows up. Nothing looks wrong. But behind the scenes, they can be operating in very different ways. The first ETF earns its income the right way. It collects dividends from stocks, interest, or option premiums from strategies like covered calls. More on that later. The fund earns cash first, then pays it out to you. After the payout, the portfolio still has the same value and ability to grow. The second ETF doesn't earn enough cash to support that payout. To keep the distribution going, it has to sell pieces of its own holdings. You're still getting paid, but some of that income is actually your own investment coming back to you in small pieces. The fund's base, that is, your investment value, gets smaller over time even though the income appears steady. That's NAV erosion. It doesn't show up all at once. It shows up gradually as repeated distributions are followed by weaker recoveries and lower highs. Over time, the ETF has less capital working for you, which makes it harder to bounce back after market pullbacks. This is where return of capital, ROC, often gets misunderstood. ROC is not automatically bad. For option income ETFs, ROC is frequently just a tax label. Option premiums aren't always taxed right away, so the distribution may be labeled as ROC even though the fund genuinely earned that income. Return of principal is different. That's when the ETF is literally giving you your own money back because it didn't earn enough to cover the payout. That's the dangerous kind, because it weakens the portfolio over time. Volatility makes this harder to spot. Markets naturally go down and recover. A sharp drop followed by a recovery is normal market behavior. That's not erosion. NAV erosion shows up differently. You see payouts continue, but each recovery gets weaker. Highs get lower. The fund never quite regains its footing. Over time, there's less capital left doing the work. And this is why no NAV erosion isn't just a retail concern. Some people hear that phrase and assume it only matters to smaller investors. It doesn't. The most disciplined investors in the world think the same way, they just use different language. Long-term investors don't measure risk by short-term price movement. They measure it by whether a strategy permanently weakens the portfolio. Temporary losses can be recovered from. Structural damage can't. That's why avoiding NAV erosion isn't about being conservative. It's about making sure income doesn't come at the cost of future income. If a fund has to give value back to keep paying you, the strategy eventually breaks down. That's why no NAV erosion, no games isn't a slogan, it's a filter. The ETFs in this video aren't selected because they pay well. They're selected because their income is structurally earned, not financially engineered. With that framework in mind, the next step is understanding how these ETFs actually generate income, because this is where the difference between structurally earned income and engineered payouts becomes visible. At the core of every fund in this video is some version of a covered call strategy. In plain terms, the fund owns stocks and sells call options on those stocks, or on an index tied to them. When those options are sold, the fund collects premiums. That premium is real cash. It doesn't rely on dividends, and it doesn't require selling shares to fund distributions. This is where volatility matters so much. When markets are volatile, option buyers are willing to pay more for protection or upside exposure. That increases premiums. For income-focused ETFs, volatility isn't automatically bad. It can actually be the fuel that drives distributions as long as it's managed correctly. There is a trade-off, and it's important to understand it. When a fund sells a call option, it gives up some upside beyond a certain price. If the market rallies hard, the fund can lag a pure growth strategy. That's not a mistake. That's the exchange being made, future upside converted into current income. Where things go wrong is in execution. If a fund sells too aggressively, caps too much upside, or relies on leverage to boost payouts, the income can start to outpace what the strategy can realistically earn. That's when erosion shows up. Not because covered calls don't work, but because discipline breaks down. The ETFs we're discussing use different versions of this engine. Some write calls on broad indexes, others focus on specific sectors. Some do it monthly, others do it weekly. But the underlying question is always the same. Are option premiums doing most of the work, or is the fund quietly leaning on its own assets to maintain the payout? That's why you'll notice a consistent pattern in the analysis ahead. Before yield, before income projections, before excitement, we look at behavior. If the strategy is sound, the fund can pay income, absorb volatility, and still recover over time. And that leads directly into the next step: how these ETFs are selected in the first place using filters, and why many high-yield funds didn't make the cut. After that, I'll walk you through the top 5 income-focused ETFs that show no NAV erosion. And at the end, I'll show you one ETF that can potentially turn 10 grand into $15,750 in 1 year, while paying over $2,800 in annual income from the very first year. But first, let's go through the filters for the ETF selection. The first filter is behavior under stress. An income ETF has to prove it can pay distributions during volatile periods without permanently damaging itself. That's why the 1-year return chart matters. It shows how the fund handles income payments when markets aren't cooperative. If income causes the price to break down and fail to recover, the fund doesn't qualify. The second filter is long-term integrity. The max return charts tell a very different story from short-term performance. Time exposes structural problems. Funds that slowly drift lower, even while paying income, are eliminated. That pattern usually signals that payouts are being supported by asset erosion rather than real cash generation. Next is strategy transparency. If it isn't clear how income is being generated, whether through covered calls, index options, or portfolio-level option overlays, the fund doesn't make the list. Complexity isn't the issue. Not being able to explain the income source clearly is. Expenses matter too, but only in context. A higher expense ratio isn't a deal breaker if the strategy genuinely earns more than it costs. What matters is whether fees are justified by durable income, not marketing. Finally, liquidity and survivability play a role. These ETFs need enough scale and trading volume to operate efficiently and adjust positions without distortion. Most high-yield ETFs fail one or more of these tests. The ones that do check all these boxes are the ones where income shows up without the structure falling apart. With the framework set, we can start the countdown. Number 5 is JEPQ, and it lands here because it shows what income looks like when structure and risk control come first. Starting with the holdings, JEPQ is heavily weighted toward large, established NASDAQ companies. About 54% of the portfolio sits in technology, with another 16% in communication services and 14% in consumer cyclical names. That mix isn't accidental. These sectors tend to have deep liquidity, strong earnings power, and persistent option demand, all critical for an option income strategy to work efficiently. Looking at the top holdings reinforces that point. JEPQ's largest positions include Nvidia, Apple, Microsoft, Alphabet, Amazon, Broadcom, Tesla, Meta, Netflix, and AMD. These companies have massive market caps and some of the most active options markets in the world. That gives the fund room to generate income without forcing trades or distorting prices. One important detail here is how the options are used. JEPQ doesn't sell calls on individual stocks. Instead, it sells options on the NASDAQ index. That lets the portfolio stay mostly intact while income is generated separately. It keeps turnover lower, reduces tax friction, and avoids selling strong positions just to keep distributions going. You can see how that plays out when you look at performance. Over the past year, JEPQ stayed positive even through periods of tech volatility. The drawdowns were there, but the recoveries were there too. That's what you want to see. It tells you the income wasn't being funded by shrinking the portfolio. When you zoom out and look at the full history, the same pattern holds. The fund trends upward while paying regular distributions. There's no staircase decline like the famous YieldMax TSLY, no pattern of lower highs that would suggest structural erosion. This is the difference between volatility and damage. Volatility shows up as movement, erosion shows up as decay. JEPQ shows movement, not decay. JEPQ also benefits from scale. With an expense ratio around 0.35% and more than $32 billion in assets, the strategy can be executed efficiently without reaching for yield or adding unnecessary risk. In terms of metrics, JEPQ's current yield sits at 9.71%. What stands out is dividend growth. JEPQ shows an 11.57% dividend growth rate, the strongest on this list. Over the past year, the share price averaged around 2%. Now, let's say Josh invests 10 grand into this ETF at the same time and holds it for 1 full year. Based on these metrics, a $10,000 investment in JEPQ generates approximately $970 in income over 1 year. The investment's value increases from 10 grand to about $10,200, resulting in a total value of roughly $11,170. That's what a conservative income setup looks like. That's why JEPQ sits at number 5. It puts stability first, not maximum yield. Coming in at number 4 is GPIQ, and this is where income starts to move higher without breaking the structure. At its core, GPIQ is built around the NASDAQ 100 universe, but the way Goldman structures the portfolio matters just as much as what's inside it. Sector exposure tells the story immediately. About 54% of the fund sits in technology, followed by nearly 17% in communication services and 13% in consumer cyclical stocks. Healthcare, consumer defensive, and industrials fill in smaller but intentional allocations. There's very low exposure to traditional defensives like utilities, financials, or real estate, which keeps the portfolio tightly aligned with growth-driven earnings and option liquidity. Strategy-wise, this is where GPIQ separates itself from JEPQ. Both rely on selling NASDAQ-based index options, but they're not doing it with the same intensity. JEPQ uses a more conservative overlay designed to smooth returns and limit downside, even if that means accepting lower income. JPIQ is more aggressive in how it captures option premium. The coverage is tighter and more income-focused, which allows it to pull in higher payouts while still keeping the overall structure intact. It's the same engine, but tuned for more income instead of maximum stability. This structure shows up clearly in performance behavior. On the 1-year chart, GPIQ is up a little over 6%, despite moving through several sharp NASDAQ pullbacks earlier in the year. Those drawdowns were followed by recoveries, which tells us distributions were not being funded by selling underlying equity. The Max chart reinforces this point even more strongly. Over its full history, GPIQ shows a positive total price return approaching 35%, while still paying nearly a 10% trailing yield. That combination is critical. If income were eroding NAV, the long-term chart would flatten or trend downward. Instead, GPIQ continues to make higher highs over time. GPIQ also benefits from scale. The expense ratio is 0.29%, and assets under management exceed $2.4 billion. Goldman isn't chasing yield, they're monetizing volatility in a controlled, repeatable way. Looking at current metrics, GPIQ pays around 10.04% with a 6.11% dividend growth rate. Over the past year, the share price has appreciated by roughly 6.14%. On a $10,000 investment, this ETF generates approximately $1,000 in income over 1 year. The investment increases to around $10,600, resulting in a total value of about $11,600. Income and price appreciation contribute more evenly to this outcome. That's why GPIQ earns the 4th spot. It meaningfully increases income compared to JEPQ, but it does so without sacrificing structural integrity. In fact, it even delivers stronger capital growth. But there are even better options ahead, and by the end, I'll show you one ETF that can potentially turn 10 grand into $15,750 in 1 year, while paying over $2,800 in annual income from the very first year. At number 3 is KQQQ, and this is where income becomes more aggressive. KQQQ doesn't try to mirror the NASDAQ 100, instead it runs a much more concentrated portfolio. The fund holds about 47 positions, with the top 10 making up more than 72% of total assets. That concentration is intentional. Curve focuses on stocks that consistently generate strong option premiums while still trading with deep liquidity and heavy institutional participation. Sector exposure reflects that focus. The portfolio is heavily tilted toward technology, communication services, and consumer cyclical stocks. You'll see names like Alphabet, Amazon, Broadcom, Apple, Meta, Tesla, Netflix, and Uber. These companies aren't included just because they're well known. They're included because their options trade actively every single day. That liquidity is what allows premiums to be captured consistently without forcing poor execution. One key detail that stands out in KQQQ's structure is the meaningful allocation to U.S. Treasury bills, which currently sit near 27% of the portfolio. This is not dead weight. Those treasuries serve two purposes. First, they provide a volatility buffer during equity drawdowns. Second, they act as collateral and flexibility for the fund's option strategy. This is one of the reasons KQQQ can maintain income distributions without being forced to sell equity positions at unfavorable prices. The option strategy itself is actively managed. KQQQ sells covered calls on the rest of the selected positions, adjusting strike selection and coverage levels based on market conditions. During periods of elevated volatility, the fund leans more heavily into call writing to capture higher premiums. When markets stabilize or trend higher, it can reduce coverage to allow equity appreciation to flow through. You can see how that plays out in performance. Over the past year, KQQQ has been modestly positive, up just over 2%, despite a sharp tech-led drawdown earlier in the year. What matters isn't the dip, it's the recovery. The fund regained ground while continuing to pay a yield above 11%, which tells you income was coming from option premiums, not from selling assets. Looking at the full history, the same pattern shows up. KQQQ is up roughly 16% over its life while paying double-digit income. That combination is what rules out structural NAV erosion. The expense ratio is higher, just under 1%, but that reflects active management, tactical use of treasuries, and dynamic option positioning. This fund isn't trying to be passive, it's designed to manage volatility and turn it into income. In terms of metrics, KQQQ yields around 11%. Dividend growth is zero, which is consistent with an option-driven payout structure. Over the past year, the share price has been up approximately 2%. On a $10,000 investment, this ETF would generate roughly $1,100 in income over 1 year. The investment value finishes near $10,200, resulting in a total value of about $11,300. Income increases compared to JEPQ and GPIQ, while price appreciation remains controlled. That's why KQQQ earns the number 3 spot. It takes more risk than JEPQ or GPIQ, but it offsets that risk through tighter security selection and active option management that allows income to be generated without weakening the fund. At number 2 is QQQI, and this fund represents a more income-forward evolution of the NASDAQ covered call concept without fully giving up long-term capital stability. QQQI starts from a familiar place. Like the previous funds, it's built on a NASDAQ 100-style equity base, and it relies on the same core idea: use liquid mega-cap technology names to support an option income strategy. The underlying exposure still centers on the companies with the deepest option markets, because that liquidity is what makes consistent premium generation possible in the first place. But where QQQI begins to separate itself is not what it owns, it's how aggressively it uses the options layer. JEPQ and GPIQ are designed to smooth income and protect the structure first. QQQI pushes the income dial further. It's more willing to let volatility show up in exchange for higher cash flow while still keeping the core portfolio intact. The sector exposure reflects that same philosophy. Technology remains the dominant weight, with communication services and consumer cyclical making up most of the rest. There's very little exposure to financials, energy, or real estate. Just like the earlier NASDAQ tracking funds, this keeps the strategy focused on areas where volatility is frequent and option pricing is consistently rich. The difference is that QQQI is built to extract more of that volatility rather than dampen it. Where QQQI separates itself is in how it manages options. Unlike systematic covered call ETFs that are overwritten at a fixed rate, QQQI uses active call writing. Coverage, strike levels, and expirations adjust with market conditions. When volatility rises, premium capture increases. When markets stabilize or trend higher, coverage eases, allowing more price movement to come through. That flexibility shows up in the behavior. Over the 1-year period, QQQI is modestly positive, up just under 2%, despite enduring a sharp NASDAQ drawdown earlier in the year. More importantly, it recovered while continuing to pay a 13% trailing yield, indicating that distributions were driven by option income rather than liquidation of assets. Looking at the full history, QQQI remains positive overall, up roughly 7% since inception. For a high-income ETF, that matters. It shows that the fund has been able to extract income without steadily weakening its base. The expense ratio is higher than passive funds at 0.68%, but that cost reflects discretionary option management and ongoing portfolio adjustments. QQQI is not trying to be the cheapest option, it's trying to be adaptable. Looking at its current metrics, this ETF currently yields close to 14%. Dividend growth is zero, which aligns with an option-driven payout structure rather than a growing dividend policy. Over the past year, the share price has appreciated by approximately 2%. On a $10,000 investment, QQQI generates roughly $1,400 in income over 1 year. The fund's price remains near $10,200, resulting in a total value of about $11,600. Higher income offsets more modest price movement. That's why QQQI earns the number 2 spot. It generates significantly more income than JEPQ or GPIQ without showing the kind of persistent NAV decay that plagues more aggressive yield products. It accepts volatility, but it doesn't let income overwhelm the structure. And from here, we move to the highest income profile on the list, where the strategy becomes more concentrated, more volatile, and far more aggressive. At number 1 is CHPY, and this is where the income profile truly separates from everything else on the list. Up to this point, every fund we've talked about shares a common foundation. They all rely on liquid equities, deep options markets, and disciplined call writing to generate income without breaking the structure. CHPY starts from that same idea, but then it removes almost every safety layer the earlier funds keep in place. CHPY is a pure-play semiconductor income ETF. Unlike the others, it doesn't spread exposure across the broader NASDAQ, and it doesn't use treasuries or defensive allocations to dampen volatility. The portfolio is 100% allocated to technology, specifically semiconductor companies across design, manufacturing, and equipment. That includes names like Broadcom, NVIDIA, Micron, Lam Research, KLA, Qualcomm, AMD, TSMC, and Applied Materials. The fund holds around 72 positions, with the top 10 making up roughly 64% of total assets. That concentration is intentional. These companies aren't chosen for dividends or stability, they're chosen because semiconductor stocks consistently have some of the most active and expensive options markets in equities. That liquidity is what allows CHPY to pull in much larger option premiums than the broader NASDAQ-based strategies we looked at earlier. This is the first major difference. Unlike JEPQ, GPIQ, or KQQQ, CHPY does not maintain a meaningful treasury or defensive allocation. Capital is deployed almost entirely into equity exposure, with only small residual cash balances driven by operational mechanics. This increases volatility, but it also dramatically increases premium potential. Semiconductor stocks experience frequent earnings gaps, sharp momentum swings, and elevated implied volatility. Exactly the environment where covered call income is maximized. The option strategy is aggressive and fast cycling. CHPY sells covered calls across its semiconductor holdings, often at shorter durations, allowing premiums to be captured and distributed on a weekly basis. That structure is why the fund pays weekly distributions and why the trailing dividend yield currently sits north of 27%, close to 28% in fact. The income stream is not smoothed or stabilized, it directly reflects the volatility of the underlying sector. Because CHPY is newer, the right way to judge it is from inception rather than forcing a longer comparison. And this is where caution matters. Many yield max option-based funds have shown clear NAV erosion over time, especially when income is pushed this hard. That history can't be ignored. So far, CHPY has managed to stay afloat. Since launch, the fund is up approximately 29%, even while paying extremely high income. That combination is important, but it's not a guarantee. It tells us that up to this point, distributions have been supported by option premiums and favorable sector conditions, not by steadily shrinking the portfolio. The key phrase here is "so far." This strategy depends heavily on semiconductor volatility staying elevated. If conditions change, the behavior can change with it. That doesn't disqualify the fund, but it does mean this isn't a set-it-and-forget-it income ETF. In terms of metrics, CHPY carries a current dividend yield close to 28%, the highest on this list. On a $10,000 investment, CHPY generates approximately $2,800 in income over 1 year. The fund's price increases to around $12,950, assuming around 29.5% price growth, resulting in a total value of nearly $15,750. Both income generation and price appreciation materially exceed the rest of the group. Most of the ETFs cluster between $11,170 and $11,600 after 1 year. CHPY separates itself clearly, showing how higher income combined with capital resilience can significantly change outcomes even over a short time frame. This is exactly why CHPY does not fit the traditional yield max narrative of automatic NAV decay. Despite an expense ratio just over 1%, the fund has maintained strong price appreciation alongside massive income generation. That cost reflects the intensity of active option management and weekly distribution mechanics. If you could only invest in one index fund, just one, that has the potential to turn $10 into a $2.2 million portfolio and pay over $6,000 a month in dividend income, click the video on your screen to find out which one it is.